reading in the derivatives material. This is risk management applications of option strategies. So when we started all this, I gave you my little primer about, remember, these are zero-sum securities or zero-sum games, and then I said remember to keep separate the underlying from the derivative contract. So we're talking about a wheat futures contract. Well, you don't have to own wheat to own a wheat futures contract or to be long on a wheat futures contract. Or you don't have to own the stock in order to have an option on the stock. So to understand the contracts, it was a good idea to simply look at the contracts by themselves. Now what we're going to do, as kind of a precursor more to level 3 than it is to level 2, we're going to talk about option strategies. In particular, we're going to talk about, first we'll talk about some hockey stick diagrams, that is, payoff diagrams and profit loss diagrams. But then we're going to actually use an option in order to hedge some type of risk. So we're going to talk about covered calls and protected puts, and you'll see that there's not a lot to it, but it does create, when you take the derivative contract, combine it with the underlying or some other fundamental asset, you can create very unique and clever payoff diagrams. So we'll see some simple examples of that here. All right, so starting off here, what we see is the call intrinsic value, also called the payoff. So if we're looking here, what we see is that we have a call option. Okay, it has an exercise price of $50. Okay, well, if the price ends up below $50, then the option is out of the money. Okay, and we end up letting the option expire worthless. So if the stock ends up at $47, I have the right to buy it for $50. Well, I'm not going to exercise my option if I'm the long. However, if the price gets up to 51, then what's going to happen? Well, now I'm up here at 51. I have the right to buy the stock for 50. I can sell it for 51. I exercise my option and I get a payoff or a terminal cash flow, also called the intrinsic value, of $1. Okay, as the stock price continues to increase, then you can see that the payoff to the long position increases linearly at this 45-degree angle. Okay, also, of course, if you talk about the short position, the short call, well, remember, it's a zero-sum game. So if you add the two positions together, you've got to get this straight line going across like this. Okay, well, what's going to be happening to the short as the stock price goes up above the exercise price? Well, for every dollar the long makes, the short has to be losing. So if the price goes to 51, then the short has to go in the market and buy at 51 and deliver it to the long for $50, losing $1. So these are just looking at the payoffs to both the long and the short, okay, at the expiration of the option contract. But remember, this is not profit and loss. Okay, the long had to pay something to get into this contract to begin with, okay, and the short received a payment at the beginning. So what does profit and loss look like? Well, these are the profit and loss diagrams. So here what we're looking at is an option with an exercise price of 40. So if I'm the long, I have paid $5 to buy this option contract to begin with. So if the stock price ends up below the exercise price and I walk away and let this expire worthless, okay, then I'm going to lose my $5 initial investment. However, as the stock price exceeds the exercise price, then I start to see this terminal cash flow going up like we talked about it in the last slide. Now, if it goes up to $41, am I going to exercise? Well, the answer, of course, is yes. Okay, I'm going to receive a terminal cash flow there, or a payoff at the expiration of $1. So I'm going to be able to buy it for 40 and sell it for 41. I'm still, however, going to be in a loss position because I paid $5 to begin with, but it's better to lose $4 than $5. So at $41, I'm still going to be losing money over here, but I'm going to be losing less. So when you buy a call option with an exercise price of $40 and you pay $5 for it, what you're really betting is that the price is going to end up above 45. That is the exercise price plus the call premium. So that is the break-even point. And of course, if you want to look at the short, well, the short receives the $5 up front. If the option expires worthless, they got $5. They get to go and play with that, do whatever they want. And then as the stock price goes up above the exercise price, okay, well, they are going to be seeing a negative terminal cash flow or negative payoffs at the end. Okay, and of course, they will break even at 45 also. If the stock price ends up at 45, the short will pay $5 at the end. They got $5 at the beginning, so they end up breaking even. And if you average this out, what you again see is the straight line. It's a zero-sum game, right? Okay, so anyway, so those are the call options. What about put options? When we talk about put options, okay, this of course we've said is a bearish position. That means you benefit when the price falls. So if we're looking at a put option with an exercise price of $50, well, if the price is up here at 55, do I exercise my right to sell stock for $50 when it's actually worth 55? Well, no, I don't. So when the stock price is above 50, this is where the option is out of the money. However, if I am long a put option as the price falls below the exercise price, then I can buy at the low price, sell to the contract at 50, and for every dollar it falls, I'm going to have an additional dollar in terminal cash flow. Just the opposite is happening for the short put on this end. So once again, you get the combined profit of the long and the short is always going to be equal to zero. What about the profit loss diagrams? Okay, well, once again, if you are long a put, that is, you have the right but not the obligation to sell this at, in this example, at $40, well, then you had to pay for that privilege up front. So whether you're long a call or long a put, you're the one that is paying the premium, right? So you paid a $5 put premium on this $45 stock, excuse me, on this let me say that again. You paid a $5 put premium on this put option that has an exercise price of $40. Okay, so what happens here? Well, if the price goes down to, $37, well, then do you exercise? Well, yeah, you can buy in the market at 37. You can put it to the contract for 40. So you end up making $3 at the end. But remember, you paid $5 to begin with. Once you pay that premium, you don't get it back. So when you buy this particular put, that is, you pay $5 and it has an exercise price of 40, you're really betting that the stock is going to end up south of, that is lower than $35, because it's not until the stock gets down below $35 that you're actually profitable, that you're above zero here, right? So you're going to exercise in this range, okay, so you can have smaller losses, but if the stock only goes to $36, you get $4 at the end, you paid $5 in the beginning, you're still going to lose value there. And of course, the opposite is true for the short put. So if the contract expires out of the money, you got $5, you get to keep it, okay, and then as the stock price falls below the exercise price, that's when the terminal cash flows become negative for the short put. And of course, if the price gets below 35, okay, then they have lost, they will actually end up in loss territory, so the terminal cash flow will be a greater outflow than the $5 they received to begin with in this particular example. All right, so if you're having any trouble looking at these, well, they're called hockey stick diagrams. I'm actually spent some time as a hockey coach. I've never thought they looked particularly like hockey sticks, but nonetheless, if this is what you're used to looking at, or if you're not comfortable with these diagrams, what I was trying to say, then make sure that you spend some time looking at them, because you don't understand options until you can understand the payoff diagrams and the profit and loss. My experience is most people do okay with the long and short call. They also do okay with the long put. For some reason, people get confused with the short put. If all else fails, okay, and you just aren't comfortable with the short put, okay, but you are comfortable with the long put, and if you get a question on the exam dealing with short puts, just calculate the outcome for the long put and then take the opposite. So if it ends up being minus $3 for the long put, then it's got to be plus $3 as either the payoff or the profit for the short put. It's a zero-sum game, so you can always go back to the long position if that makes more sense to you, and then just put a negative sign in front of it, take the opposite for the short side of the contract. And that works actually with all of these, right? So swaps and options and all the forward contracts, futures contracts, you can always look at the long. So anyway, what about profit and loss? So we're looking at a 40 call purchased at $3 when the stock is trading at 39. Okay, so we're going to consider a 40 call purchased for $3 when the stock was trading at 39. Okay, well, what is our maximum profit here? Well, if we buy a call option, there is no theoretical upper limit to the price of the stock. So the price could go up to 41, or it could go up to 50, or it could go up to 100 or 1,000 or whatever. So there's no upper limit on the maximum profit from a long call. What about your maximum loss? Well, you've invested $3. If the price ends up less than $40, you're just going to walk away. So the maximum loss is going to be the $3. And what are you betting is going to happen? Well, the break even is going to be the exercise price plus the call premium of $43. Okay, so if you end up at less than 43, you're going to lose money. If you end up more than 43, you're going to make money. If the stock price ends up at exactly 43, you're going to break even. You paid $3 to get into the position, and you have a $3 terminal cash flow. So what's the option value and the gain or loss if the stock price is at $42 at expiration? Well, if it's at $42 at expiration, okay, well, what's going to happen here is that the option is going to be worth $2, right? So the expiration is going to give you a cash flow of $2. That is S minus X. 42 minus 40, but you paid $3 to begin with, so the loss is going to be a $1 loss. So you paid $3 to get in, you got $2 back. All right, so that would be an example of profit and loss on a long call position. All right, now let's talk about these two covered positions, all right, or these two risk strategies where you're going to take a fundamental security and you're going to combine it with a derivative. Okay, so in this case, we're going to have a covered call, and then we're going to talk about the protected put, and then we are going to be done with all this derivatives material, right? So a covered call, this is where the writer owns the stock and sells a call. So you're actually going to have the stock. Okay, so you're going to buy the stock for whatever the stock price is, and then you're going to sell a call against it, right? So if the value of the stock goes down, that is, if you have any losses on the stock, it's going to be reduced by the fact that you received the premium. And what's happening here is the writer is going to trade the stock's upside potential for the option premium. So what we'll see, of course, is that if the value of the stock goes up a little bit, then this position will do well. If the stock goes down, then this position will do well relative to just owning the stock. Okay, and if the value goes way up, then this position is going to underperform. Why? Because you have sold off the upside potential. You are short a call. You've given somebody else the upside potential to this particular position. So if we do it this way, we're talking about we're going to buy a stock for $39 and we're going to sell a 40 call for $3. So we're going to bring in $3, right? So, and then somebody else is going to have the right to buy this from us at a price of $40 if they want to. So what's the net cost of the position? Well, we're just going to pay $39 for the stock. We got $3 when we sold the call. Okay, so we end up $36 into this. So what's our break even? Well, if the stock goes down to $36, we paid $36 to get in. Okay, the stock's worth $36 at the end of the life of the option. The option expires worthless, so the break even is going to be $36. What about our maximum gain? Okay, well, we got in at $36. Okay, if the price ends up at $39, so the stock price doesn't move, then we still made $3, but we get a little bit of upside potential. That is, we get some potential up to this $40 value, or up to the point where the stock is worth $40. So what's our maximum gain? Well, if the stock price goes to $40, okay, we paid $36 to get into it. Well, our maximum gain is $4. What about our maximum loss? We don't have any loss protection here. We're in at $36. If the stock price goes to zero, then we're going to lose all $36, right? Okay, so what about profit and loss if the stock price ends up at 39? Well, we paid 36, stock price ends up at 39, so we make $3. What if the stock price goes down to 32? Well, we have a net cost of 36. The option expires worthless. The value of the stock goes to $32, so we end up losing $4 if the stock price at the end ends up to be this $32. All right. So if you wanted to graph this, you can look at what the payoffs to the position. So what we're saying here is that if you just owned the stock, you would have payoffs on this straight line, right? So if the stock price went way up, so you're way out here, you'd have big gains. If you were way down here, you'd have big losses. What we are effectively doing is we are truncating the upside potential. So we're selling that away, but you can also see that we are picking up the $4 here in the shift as we pick up the option premium. So if that makes good sense to you, then hang on to that logic. But the big thing up here is the fact that we are truncating the upside potential on the upper part of this graph. All right, so that is one of our risk management positions. Now we're going to look at a protective put. So a protective put is even easier. So this is something that I don't think will give you a whole lot of trouble. But here we're going to be long the stock, that is to say, we're going to own the stock, and we're going to be long a put. So we are buying the right to sell that stock. When would we want to exercise that? If the price falls. So any gain on the stock, is going to be reduced by the premium that we paid for the put, okay, but the buyer is getting protection against the stock price falling. So if you need to hold on to stock for some period of time because it's letter stock, it's restricted, you can't sell it, okay, you're worried that the price is going to go down, well, you could take a protected put strategy, right? So you could take your stock, you could sell, you could buy puts, and then if the price falls, you could always put that stock to the contract at the put price. So effectively, this is buying stock and then buying insurance. And if you buy insurance, of course, well, then you're bought insurance and you paid for insurance, and if the stock price goes down, you'll use it. If the stock price doesn't go down, then you won't use it. Okay, so looking at a quick example, suppose we paid $41 to buy a stock and we buy a 40 put for $3. Well, what's the cost of this position? Well, we paid $41 for a stock, we paid $3 for a put, so we're into this $44. Okay, if the stock price goes above 44, well, we still got all that upside potential. If it goes below 44, and then we're going to end up with some loss on this, so our break even is going to be exactly at $44. What about our maximum gain? Well, once again, we have a stock here that we get the upside potential on. There is no theoretical upper bound to the value of a stock, so the price of stock could go to 50 or 500 or 5,000 or whatever it is. That is unlimited. You're not limiting your upside potential by taking on a protected put strategy. What's your maximum loss? Well, your maximum loss, you're in at $44. What if the price goes down to 20 bucks? Well, remember, you've locked in the right to sell this at 40, so any stock price variation that takes the stock below 40 is the same to you. So you're in at 44, you sell the stock for 40, okay, your maximum loss is going to be $4. What if the stock price ends up at 47? Well, once again, you're in at 44. Okay, so if you go to 47, what's going to happen? You're going to have a $3 profit. If it goes to 38, you're going to be below the $40 share price. So as we already talked about there, your maximum loss at any price below $40 is going to be equal to that $4. So what's happening here in terms of a payoff diagram? Well, again, what we would see if we just bought the stock is we would have this straight line relationship. As the price goes up, we may have big gains. As the price goes down, we have big losses. What we wanted to protect ourselves from here, okay, was the idea that the stock price could fall a lot. So we have bought this put option, okay, that gives us a floor on the value of the stock at 40, okay, and so if we end up below 40, then we're going to get the $40 from the put, okay, and if it goes above 40, then we're going to get the payoffs as the stock goes up. So we still have the upside potential. All we've done is move everything down by $4 because we paid $4 for the put in exchange for truncating the lower part of the distribution. That is, we're not going to go down to zero. We're never going to go below this $40 put price. And that is the derivatives material. So I think that this is relatively approachable. If you're not used to dealing with derivative securities, there are some ins and outs here. So there's lots of little things to remember. I think the key to this material obviously is to spend some time practicing. So make sure that you go through and you work problems in each of these areas with futures and forwards, with options, with swaps here with the protected put and the covered call. If you'll do that, I think you'll find that the learning curve is pretty sweet here. You'll get on top of this material pretty quickly, and it's going to have some influence on the exam, so you want to make sure that you're prepared for it. And in addition to that, you don't want to look past the level 1 exam, okay, but this material ramps up significantly at level 2, and if you don't understand the basics here, it's going to be hard to get on top of there. So not only learn this for the exam, but learn it and be able to retain it until you get to that level 2 exam. Good luck on this material. I hope you do really well on the exam.